I want to talk about asset allocation, which is the primary element that's either going to give you inflation-beating returns or not. Let's start a few years ago with Warren Buffett's annual letter to shareholders 2 years ago. In that letter, he looked at investment and he defined investments. He said investment is sacrificing current consumption so that I can consume more at a future date. That means I'm not going to have one cappuccino now so that I can have 2 cappuccinos in 5 or 10 years' time. Not half a cappuccino in 5 or 10 years' time. So therefore, in principle, you need to outperform inflation. What he did then is he split investments into 3 categories. Firstly, interest-bearing instruments. That's where you only earn interest over longer periods of time and your performance is not really going to beat inflation. The second one is investments where you buy it on the principle that somebody will pay more for it in future. That means you pay a certain price for it now and you hope that someday in future somebody will pay more for it than you paid for it now. That's things like gold and shark's teeth, as he put it. Thirdly is growth assets. Now that's the assets that over long periods of time has the ability to outperform inflation. He splits that in equities, that means a share in a business, commercial property and agriculture land. Now let's start with South African retail investors. If you look at the performance of South African asset classes over the last 113 years, since 1900, the study that reflects it the most accurate is annually done by Swiss Re. Swiss Re takes 17 countries and they look at asset class performance over this period and then publicize this on a per year basis. If I look back at the last 113 years, the inflation rate on average was just shy of 6%. That means you needed to attain growth of more than 6% in order to beat inflation, in order to buy 2 cappuccinos. If you get less than 6% over the long period of time, you are not going to outperform inflation. Now, equities over this period gave you just more than 12%. That's nice. That's above inflation. Bonds gave you roughly 2% above inflation, between 1 and 2%. That's barely beating inflation. Keep in mind, there might be tax elements that could push you below inflation. Money in the bank just beat inflation by about 1%. Again, there might be tax implications. So if you look at those asset classes, there are certain asset classes that will outperform inflation, others not. Commercial property in South Africa is a growth asset. It has performed very well over longer periods of time and gave you returns that are not false equity returns. It gave you real returns. Residential property, on the other hand, be very careful. It barely beats inflation over longer periods of time. You have to make sure as well that your primary residence is not necessarily an investment decision. It's a lifestyle decision. You want to live somewhere. You want to enjoy life. So be very careful to measure your primary residence purely on investment terms. Now, where does this leave us? That means that over longer periods of time, if you want to beat inflation, if you want to stay ahead of inflation, you need enough exposure to growth assets. You need to make sure you have a balanced portfolio with growth assets. Your biggest enemy in the long term is inflation. That is where people get caught. Not market volatility. They get caught by inflation. So make sure your portfolio has enough exposure to growth assets. And that is share in a business, equities, or commercial property.